Welcome back. Today we're delving into Life Insurance Chapter 3 of the Life and Health License Exam Manual. Let's get started. First question. Insurance agents are appointed by who? The answer is simple. Insurance agents are appointed by the insurance companies. Next, life and health insurance producers have the authority to bind an insurance company to a contract. Is this true or false? It's false. Life and health insurance producers do not have the authority to bind an insurance company to a contract agreement. But why? Life insurance involves massive long-term risks. The company cannot allow an agent to commit them to such high liabilities instantly. The insurer must first perform underwriting, assessing medical history and risk profiles before the contract becomes binding. Final approval stays with the home office. Moving on. Bob is a producer for Haven Insurance. His contract states he can put the company's logo on his business card and office door. This is an example of express authority. Is the authority specifically given to the producer by the company in writing? Now, say Bob has his policyholders mail checks to his home. His contract doesn't allow this, but the insurer is aware and hasn't asked him to stop. This is apparent authority. Because the company has accepted the behavior time after time, the producer's actions are deemed authorized. If Tina accepts the initial premium when she sells a policy, but her contract doesn't mention handling premiums, what is this an example of? This is implied authority. It is not expressly granted in the contract, but it is actual authority granted in accordance with general business practices. This is a part of a business practice on a daily basis. It isn't written, but it is implied. Alicia's life insurance premium is due on the 10th, but she's always sent it late. The insurer accepted this for 3 years without complaint. Then a new CEO comes in and decides to crack down, canceling Alicia's policy for non-payment. Alicia contests this decision legally. She gets the policy reinstated. The decision to reinstate the policy is an example of estoppel. But what exactly is that? Estoppel means that one party that has given up a right may be blocked or stopped from changing conduct after another party has grown to rely on it. If you have accepted it for any length of time, you can be stopped from changing it. The customer was relying on that same practice you established. Which element is not necessary for a valid contract? A written document is not necessary, but a legal purpose, consideration, and competent parties are. A contract requires an agreement, an offer and acceptance, consideration, competent parties of sound mind, and a legal purpose. Without these, there is no contract. The initial premium payment sent with an application constitutes which part of the insurance contract? It constitutes consideration. Consideration is an important part of an insurance contract. Put simply, consideration is something of value. Life insurance contracts include all of these except a policy folder. They do include an insuring clause, conditions, and exclusions. Cat has paid only 4 premiums on his health insurance policy when he is hit by a car. The insurance company pays out nearly $500,000. This is an example of an aleatory contract. An aleatory contract depends upon an uncertain event where each party may not receive the same value. Daryl applies for a life insurance policy and pays the initial premium. By doing this, Daryl has made an offer to the insurance company. The insurer decides to offer Daryl a modified policy with an exclusion he hadn't agreed to. The insurer has now made a counteroffer. In other words, the insurer reviewed the application, made changes, and notified Daryl. That change is a counteroffer the insured must consider before accepting. The failure to disclose known facts in an application is called concealment. This is crucial to remember. When one party may receive much more than given in exchange, it is called aleatory. An insurance contract is dependent on chance or an uncertain outcome. Misrepresentation is a written or oral statement that is false, while concealment is the failure to disclose known facts that could affect the application. A material fact is one crucial to accepting the risk. Fraud, however, is an intentional act designed to deceive another party into a contract. Insurance contracts are conditional contracts because certain conditions must be met to make the contract legally enforceable. In a contract of utmost good faith, the parties have a duty to each other to disclose all material facts relating to the contract. Life insurance contracts are not considered to be personal contracts. A policyholder can assign their policy to a bank as collateral on a loan. Insurance is a contract of adhesion. The insurance company drafts it, it's not negotiable, and courts interpret ambiguity against the party who prepared it. A unilateral contract is an exchange of an act for a promise. After the premium is paid, only the insurer is legally required to do something, pay the death benefits. A warranty is a statement considered guaranteed to be true. Any breach provides grounds for voiding. A representation is only believed to be true to your best knowledge. The parole evidence rule disallows oral evidence based on statements made before the contract was created. Once signed, everything discussed before is considered settled. Lastly, there are void and voidable contracts. A void contract has no legal effect. A voidable contract may be set aside by one of the parties for a satisfactory reason. Don't forget to read the chapter on agency law. It is an important part of the process. Commit to study. Good luck out there.